Investors, there are no guarantees in the stock market, and the first 2 months of 2025 are proving that a lesson to those who just entered the markets over the last 2 years and enjoyed over 20% returns. It's been a sloppy, choppy mess that, while uncomfortable to those watching day to day or week to week, as we previously warned, is not unusual. It is likely to be the case for the first couple of quarters in 2025. Take a look at the 2-year chart of the S&P 500. I've drawn the general upward sloping channel we've been in for that time period. On the chart, you'll see that we've traded outside this band in October of 2023 for about a month, as many were preaching the end of the bull market, a recession, Elliott wave theory, generational tops, or the biggest nonsense I recall at the time, the coming, a replay of the 1987 stock market crash. We felt none of those things would happen. We were coaching our followers to be buyers of stocks back then. On this same chart, you'll see the mid-summer pullback in July and August of 2024 caused by the unwind of the yen carry trade, delevering, pretty much on cue for a normal summer sell-off. You'll see the gap higher in early October as Donald Trump won the presidential election with a landslide victory. Which brings us to here and now, the present, the first 2 months of 2025. January went up about 2.7% and February was down about 1.4%. And take a look at the Bloomberg S&P 500 seasonality matrix for the last 10 years. You can compare prior years, including the first Trump term. However, the more important data set in my eyes is the one we presented for a number of months from the quant team, Steve Supmeyer's group at Bank of America Merrill Lynch. It's the monthly average seasonal returns under the first year of a presidential cycle since 1929. As you can see, historically speaking, the first 2 months of the year are underwhelming net. In fact, the whole first quarter has historically been a sloppy, choppy mess. Those who have followed the markets for a long time should not be surprised about the neurotic start to 2025 for the stock markets. We've previously warned followers that 2025 was unlikely to be a repeat of that gloriously boring and straight line up of 2017 under the first Trump presidency. The main reason we did not see a direct repeat coming in 2025 was the fact that in 2017, Donald Trump focused on just one thing: lowering taxes and getting that policy through Congress. Lower taxes equals lower friction on consumers and corporations, and shareholders love that. The GOP's linear focus on taxes caused the S&P 500 to move upward in 2017 in a near linear and historic low volatility year. Compare that to Trump 2.0 out of the gate. As we've discussed, it appears that Trump is going for the early shock and awe, taking on a myriad of policy changes in a rapid-fire manner. Immigration, tariffs, foreign policy changes, and government firings and downsizings by the Doge group, while potentially good for taxpayers and citizens over time, in the short term, do what? Yep, all these things increase the cost of the economy short term, and shareholders and financial markets hate added friction. So the S&P 500 has gone almost nowhere since Donald Trump was re-elected as of this filming February 28. As we pointed out, while others weren't, the economy was already slowing into the election as the momentum in the Biden-era spending programs like the IRA peaked mid-summer of 2024 and was already decelerating. As we also discussed in December, the current policies in DC were crushing economic growth expectations. Take a look at the fast twitch 1-year real interest rate chart. At peak Biden IRA spending last summer, it was 4%. Investors heading into the election, it had already been cut in half to about 2%, and post-election, it plunged back to 0. Why? Because all of the current policies in DC are actually anti-economic growth in the short term. Immigration reform is anti-growth and consumption over the short term, and so is tightening policy. Mass federal government firings in DC may be more efficient and good for the U.S. taxpayer in the long term, but in the short term, it's bad for economic growth and consumer sentiment. Finally, with tariffs, investors stop listening to politicians. Tariffs are taxes on consumers and initially promote higher prices and lower unit consumption, and both are bad for economic growth in the short term. We've previously discussed this economic weakness and ongoing slowing fast trend a few weeks ago in our behind the scenes, what many on TV won't tell you, the economy is slowing fast video, giving numerous reasons, including the ending of the Biden fiscal stimulus sugar high, as well as increased uncertainty and economic concerns of the Trump Doge programs, causing increased unemployment and dropping consumer sentiment and retail spending. Investors, at the same time that growth forecasts are slowing to a halt, real-time inflation's expectations have steadily risen since Trump administration took office. That's the tariff programs, as well as normal seasonality of inflation in the US. It took me leaving town for others to show their concerns and sell stocks hard at the end of February. Investors, however, please remember that the second half of February is historically one of the worst periods for stocks during a year, particularly under the first year of a presidential cycle. Admittingly, I was getting a bit depressed when I came back from my vacation and few days off in New York City last week with the market dumping. However, investors, there is hope. In last week's video, Stock Rallies Start Here, Friday Fights and Stock Flights, that aired just as the market reversed up strongly on Friday, was my first shot at bringing you some good news behind the scenes. Actually, I got even a little more optimistic thinking about the next 18 months as the markets headed down early Friday on the Trump-Zelensky argument was happening on TV.
Don't tell us what we're going to feel. We're trying to solve a problem. Don't tell us what we're going to feel.
I'm not telling you.
Because
I'm
you're in no
answering
position
on
to
this
dictate that.
That's
Remember
exactly
this.
what
I'm not
You're
dictating.
in no position to dictate what we're going to feel.
Why? Here's why. What if Trump is crazy like a fox? As a voter, you don't have to like him or his policies, but that's not what investing is about. It's about return on capital and return on your investment. I got to thinking midweek. In Trump 1.0, he focused on the easy things, or actually one easy thing his first year in 2017, tax reductions, which all investors love. It was only after 2017 he started focusing on other policy agenda items, the hard stuff, the stuff that caused friction between investors and the economy. And he was doing that as the Fed was raising rates. What if this time around, he and his staff have decided, let's tackle all the hard stuff first? What if they think the economy is pretty good, albeit overstated, but let's get all that friction items out of the way in the first 6 to 9 months? Tariffs, immigration, efficiency, Doge, defense spending. Let's get that all done first, and then we'll focus on the easy stuff, the stuff everyone who's a shareholder and consumer likes, the stuff of lower taxes and less regulation, things that lower friction in the economy, things that would accelerate the economy in late 2025 and throughout 2026, so GOP members can get elected or re-elected in the midterms in the second half of next year, 2026. What if, from an investor's standpoint, he's crazy like a fox? Think about that. The good news is, historically speaking, looking forward over the next 3 to 6 months, is the seasonality is about to flip into investors' favor as a tailwind. Looking again at the first-year seasonality of returns from Steve Stepmeyer's group, if history is a good guide, you're supposed to be buying the February dip in stocks. Investors, why might this seasonality kick in positive for stocks in the coming days and weeks ahead? Here's a couple of data series that support a rally starting here or shortly. Historically, real growth expectations for the economy almost always crater the first few months of a year. Look at the fast twitch 1-year real growth rate chart again. Look for the timing of the lows on the chart. I've circled a bunch of them. Guess what time of the year each of those circles near the lows happen? Yep, between the last day in February and the middle of March. Call it option expiration in March, which this year is March 20th. If we were to look into inflation expectations chart, want to guess what trend you would see there over the long periods of time? Yep, you guessed that one too. Inflation expectations usually peak right at the end of February or at latest by the mid-March. No guarantees in 2025, but history is on your side. Finally, and possibly most importantly, in the span of fewer than 8 weeks since Trump was elected, bears are everywhere, even with the S&P 500 only about -3 to -5% off its all-time high. We have referenced the AAI investment sentiment data extremes many times over my 7 years here at Oak Harvest, including near the panic COVID lows in 2020, making a case for buying, not selling stocks. This measurement of stock sentiment has historically been a very good contrary indicator, with markets troughing when bears are high and the S&P 500 peaking when bears are very low. Take a look at an updated chart of just this bearish component of AAII hitting highs only seen at the COVID lows and the lows in the Great Financial Crisis in the first quarter of 2009. Recall in March of 2020, the S&P 500 was down over 22% when the AAII reading hit positive 52%. The S&P 500 is currently down about 3 to 5%, and bears have grown to 61%. Not only has the reading of bears skyrocketed, but the AI bull reading has plummeted. According to Chris Gallipo, senior market strategist at Franklin Templeton, since 1986, there have only been 2 readings of AI bulls less than 20% and 3 readings of bears greater than 52% before the last reading. The 1-year average forward return from bulls under 20% was almost 21%, while the 1-year average forward return to the S&P 500 for bears over 52% was a bit over 15%. Of course, there are no guarantees in the stock market, and this is based on historic investor behavior repeating as it's been doing under the old normal since October 2022. As we previously mentioned many times, soft landings in the economy do not guarantee no volatility. This time, the Trump administration seems to be going for that early shock and awe, taking on the tough policy issues first. The good news, we are oversold and historically speaking, nearing what is normally a low in both economic growth expectations for the first quarter and a seasonal low in the stock markets, along with, yes, a seasonal high in inflation concerns. As one can see, while February has historically been down in the first year of a presidential term, that downturn has historically been the best buying opportunity in soft landings, however rare they are. Investors know that regardless of the path for the economy and the financial markets in the next few months, the investment team at Oak Harvest will be here, crewing the ship and adjusting our models where we can. We expect 2025 to be a very active year for active stock management. With that, from myself and from everyone here at Oak Harvest, have a blessed weekend.